It seems like
Thank you
there's not going to be much fanfare now. At least the markets are pricing in. Jackson Hole is not going to be that exciting. No surprises. It's virtual, so we're not going to get any big announcement from Jay Powell. Are markets right to assume that?
Yeah, I don't think there's, you've got that right. I don't think there's anything big emerging from this meeting on Friday. But we do expect, obviously, quantitative easing to begin at some point, maybe perhaps this fall, and last maybe over a period of 10 to 12 months, and maybe even into early 2023.
What would then be the investing strategy at this point? Because investors, at least this part of the world, Nancy, we wake up and the headline after headline is index hits record, index hits record. Is it a passive investing story at this point, or do you get more picky?
Well, I think that from the time of the pandemic last year, it was very easy to see everything just go up. But now we're hitting new all-time highs almost every week. So I think it's time to be a little more selective and really look for value. The quantitative easing is going to be very important if it's done properly and over a period of time. We're hoping that the Feds don't do anything to just shock the market and do anything sudden, because that would cause the market to go jittery.
Yeah, to David's point, we've seen, 50 records in the past 161 sessions when it comes to U.S. equities. And there doesn't seem to be any consensus, Nancy, about where the S&P is going to go. I mean, if you take a look at this chart, we show how wide the range is when it comes to forecasts. And that spread is about 1,000 basis points. What direction do you think we're going to look at here moving forward? Are we going to keep going up? And when you talk about you got to be more selective and find value, where is that?
Well, clearly technology, healthcare, and home improvements will continue to flourish. You do have to be a little more selective. You know, it's not just an up market, but it's still going to flourish. I also believe that we are still in the recovery mode. So yes, the market will likely continue to do very well for a little bit longer, at least until the end of the year. So my advice would be stay the course, but still be cautious, because there's always something that will happen that will cause the market to go the other way short term, but then it reverts back to what really should be going on. Lots of opportunities out there, but you have to be very cautious about it.
And part of what at least you're thinking, Nancy, is when you look at the tech space in the U.S., still, you think not overvalued. I'd go as far as saying that the next 12 months, 18 months, with rates under upward pressure, it's that part of the market where you have high multiples that tend to come under pressure. Why don't you think this part of why do you think tech is still an opportunity, basically, is what I'm trying to get to?
Well, because it's clearly been pandemic proof, throughout this whole time. In fact, it's quite the opposite. It's actually flourished. That whole sector has absolutely flourished during this time frame, and will continue because there's going to be newer and faster innovation, especially in the healthcare sector, healthcare and technology. So I don't believe that we are overvalued yet. There's still quite a bit of ways to go here. The things to be cautious about are the Federal Reserve Board, what they're going to do about interest rates, what's this infrastructure bill going to give us, if it's going to be higher taxes, that could cause markets to get very jittery. Also, this the virus variant. Will there be more and more restrictions? And I don't think we're going to have a lockdown, but I think that that could be a cause of being a little bit more cautious. And then, of course, the new thing this week is the situation in Afghanistan. What's the long term, or what can we surmise from that? That's quite a new wrinkle this week.